Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's get across what we saw on global markets overnight. Equities falling while longer dated bond yields rose. Gold extending its record high. On Wall Street, the share market began the shortened week low as traders reacted to a US federal appeals court ruling on Friday, ruling that President Trump's tariffs are illegal. All major indices finished down, with real estate among the biggest S&P sector declines there. Among the Mag 7, Nvidia, Apple and Amazon, which are at the front line of Trump's trade war with China, fell, with Nvidia's share price dropping below its 50-day moving average following last week's results. However, shares of Alphabet rose more than 6% in extended trade after a US court ruled that Google will not have to sell off Chrome in online search monopoly case, but the tech giant has been ordered to share data with competitors in online search. Shares of Kraft Heinz dropped after the company said it will split in two, one focused on groceries, the other on sauces and spreads. Shares of PepsiCo gained after Elliott Management disclosed a $4 billion stake in the beverages company, launching an activist campaign. And shares of Corona beer maker Constellation Brands falling heavily as the company cut its 2026 forecast due to soft consumer demand, driven by tariff-related price hikes and economic uncertainty. And US-listed shares of the gold miners rose, tracking the price of bullion higher. Well, President Trump has said his administration will ask the Supreme Court for an expedited ruling on tariffs that a US appeals court found illegal last week. The court allowed the tariffs to remain in place through to October 14th to give the administration a chance to file an appeal with the Supreme Court. The ruling threatens to undercut the president's use of levies as a key economic policy tool. US Treasury Secretary Scott Bessent saying he's confident the court will uphold the president's use of emergency powers to impose the tariffs on most trading partners. Meanwhile, US manufacturing shrunk by more than expected last month. That's according to an ISM report, potentially giving the Fed more room to cut interest rates this month. Meanwhile, in the Eurozone, inflation in August rose to 2.1% year on year as expected, while annual core inflation remained steady at 2.3%. The US two-year Treasury yield rising to 3.65%, the 10-year at 4.27%, and markets are pricing in an 85% chance the Fed funds rate will be cut by 25 basis points at the next meeting on September 18th, with around 5 more cuts in total in this easing cycle. The US dollar index was up more than 0.5% on the day, and the Aussie has fallen back to 65.2 US cents. Bitcoin is trading at around 111,000 US dollars. Oil prices have risen after the US imposed sanctions targeting Iran's oil revenue stream, and ahead of an OPEC Plus meeting this weekend where analysts expect the group will not unwind remaining voluntary cuts. Brent crude futures up around 1.5% to $69 a barrel. Copper up 1%, iron ore rising to 102 US dollars a tonne, and gold up more than 1.5% to a record of $3,532 an ounce. Let's get across what we are seeing on Wall Street. And Chief Market Strategist at Interactive Brokers, Steve Sosnick, joining us again. Steve, welcome back. So, of course, you had that long weekend, markets playing catch-up, but clearly you're focused there on that ruling of Trump's tariffs being illegal.
Yeah, good morning, Andrew. It's great to see you again. that was really kind of a bombshell Friday night. It came out after markets were closed, and just ahead as people were either leaving or had left for a 3-day weekend. So there was a lot of angst to digest on that one. The reaction's interesting because on one hand you'd say this is great news because okay, as consumers we're not going to get charged the tariffs. On the other hand, there's two problems. Number one, the government was really counting on that revenue to offset some of the deficit raising impact of the so-called big beautiful bill. Secondly, it's another thing that makes it harder for businesses to plan. Businesses worldwide, well-managed businesses, can figure out how to manage under various circumstances. They can't necessarily figure it out if the rules keep changing on them. And yet again, there's a potential rule change here. So that is why we got off to a worse than expected start today. Also, it didn't help that a lot of global bond markets, particularly those in Europe, got off to a negative start as well, which put a damper on sentiment too.
Interesting, because I just mentioned there, Constellation Brands, for instance, falling. It's cut its forecast due to soft consumer demand driven by those tariff-related hikes. So we are seeing this play out, particularly for those consumer-facing stocks, are we not?
Yeah, definitely. Although it was interesting that consumer staples was the only sector that was marginally higher in the morning when basically the market was really at its lows. There's another thing to keep in mind with Constellation Brands, and that is they didn't really highlight this, but they make beer in Mexico, and a lot of their customers are Mexican Americans, and they alluded to the fact that a lot of them are staying home and are particularly uncertain economically because they're afraid of getting deported. And so there's Constellation Brands in many ways is sort of an oddball company. It is, it's interesting because after Bud Light had the whole hoo-ha with having a transgender spokesperson, they fell out of favor. And ironically, all the MAGA folks who boycotted Bud Light allowed Modelo to become the most popular beer in America. So things are not always what they seem here.
Yeah, right. Elsewhere, corporate-wise, I mentioned also that ruling for Google. So looks as though it's come out of that reasonably well, although it does have to make some concessions.
Yeah, I mean, the market reaction was quite positive because there were some fears, of course, that they could be forced to divest themselves of Chrome. I think there were actually some sort of trolling bids out there saying if you have to sell it, we're willing buyers. But that didn't come to pass. And also we saw Apple rally because, as you noted, the ruling affects payments that Google pays for exclusivity on platforms such as the iPhone, but it doesn't prohibit it completely. And had that happened, that would have been a big source of concern for Apple because, quite frankly, Google pays them billions for that privilege. So all in all, we were already off the lows. We'd gotten about half of the declines back by the end of the day. And that news sent futures higher after the close because, quite frankly, it's impossible for futures not to rally if you have stocks the size of Apple and Alphabet rallying sharply in the post market.
Steve, more broadly, when you take a look at the market, we are, of course, now in September. Is seasonality at play? Because obviously, traditionally, September, October do tend to be weaker.
Seasonality is such a strange thing because I've been asked that question all day. Oh, is it because it's September? Yes and no. I actually did the work on this. September is definitely the worst month for markets. That is unequivocal. Looking back over 25 years, only 4 months definitely showed average negative returns for a month. It was January. Honestly, I forget if it was April. I think January, April, June, but definitely September is by far the worst at about at over 1% average decline. And last year, where we were up 2%, broke a 5-year streak of declines, fairly significant declines in September. But the point being there, it doesn't happen all the time. So over those past 25 years, 13 of the Septembers have been lower, which also means, by the way, that 12 of them have been up, and which also means that the odds of September being up are about those of a coin flip. 12 out of 25 is just shy of 50-50, right? So I don't want to read too much into it. Now, the market can, of course, make itself believe things. I mean, if enough people believe in something market related, it will come to pass because that's the way market psychology works. And there are also plenty of reasons why we might see some risk aversion, because essentially we've been risk tolerant, risk assuming as a market for the last, call it 3-4 months. So it's not unreasonable to see the market taking a little bit of profit, especially if the bond market is presenting some challenge. But I'm going to discount the idea that it's simply because the calendar flipped that people all of a sudden got more risk averse. I think it's one of several factors affecting that.
Now, Steve, as far as the US economy is concerned, we did have that latest ISM read. The economy shrinking for a sixth straight, factory activity, I should say, shrinking for a sixth straight month there. What is that telling you? I guess particularly as it relates to tariffs. Also, we get some key jobs data later this week as well.
Yeah, I mean, the ISM number is one of a series of numbers that have just not been telling a great story about the economy. It does, of course, raise the question of do you if you really want rate cuts, do you want the weak economy that justifies it? That's a little tough, but so it's clear that there are signs that the economy is slowing down. But bearing in mind the Fed's dual mandate, we got core PCE last Friday, which at least gave us something to focus on the Friday before a holiday weekend. And that number was in line on the surface. It was 0.3. It was actually 0.27, I believe, when you round it when you take it out to 2 digits. But it was also the fourth straight month where it rose ever so slightly. So that trend is going in the wrong direction. And so that's the prices segment. And now the Fed has still no clarity about whether tariffs are going to raise the cost of goods or not raise the cost of goods. I'll argue even less because it's so up in the air. So it falls to the other half of the dual mandate, maximum sustainable employment. We're going to find out on Friday whether the trend in jobs numbers, that we saw with the revisions last month, really push the Fed to the side of needing to cut rates or not. Powell certainly at Jackson Hole changed his stance more or less from prove to me why we need rate cuts to prove to me why we don't need rate cuts. It's still not clear that all the Fed governors and voting members are on board with that. The preponderance of the belief is that it's toward rate cuts. It was about a 93% chance when I looked today. Although, by the way, that was about a 105% chance 3 weeks ago when there was actually talk of 50 basis points. That's gone by the wayside. But this number is going to tell us a lot. I hate to overemphasize numbers too much, but when you've got the best read on half of the Fed's dual mandate, it's almost impossible to not put a lot of significance on that.
Well, Steve, enjoyed the rest of the week. Thanks so much for joining us from Interactive Brokers.
Thanks, Andrew. We'll talk again soon, I'm sure.
Let's check the local market just ahead of the open here. We are expecting another lower start there. SPI futures off 0.4%. So, well, is seasonality at play? Certainly we have begun September on a negative fashion. We'll get right across that in just a moment.